Welcome to Trade Ideas. I'm Jake Merl, sitting down with Michael Guide, portfolio manager at Pension Partners and author of the Lead Lag Report. Michael, great to have you back on the show.
Always a pleasure.
So you've been here several different times over the past few months talking about the probabilities of a spring crash for stocks. Now that thesis didn't quite play out as the Fed stepped in with this dovish pivot, and you were just here a few weeks ago talking about how emerging markets should outperform the S&P in this easy money environment as the dollar weakens. So what exactly are you looking at now?
Yeah, so look, it's clear that central bank paranoia is in full swing. Right? It's not just happening with the Fed. It really was sparked by the ECB last week, and it seems like there's this very serious worry that the direction of inflation expectations has to be reversed. And a lot of the argument I was making around a potential spring crash or big collapse really related to a potential liquidity scare, which it seems that central banks now are trying to get ahead of. They're obviously seeing something clearly was ridiculously wrong, the fact that they are now reversing course so aggressively. Now, this is a debate about inflation and deflation. And in terms of time frame, whether you're able to get inflation expectations to pick up near term versus very long term. A couple of things to I think through here. One is the Fed likely is going to do something. Likely they're going to cut rates. Likely the ECB is going to take on further action because at this point they kind of have to. The argument is that that's a form of insurance, just in case things get worse with the trade war. Problem, of course, is that, at least historically, when the Fed has cut 2 times in a row, that's preceded a recession. Doesn't have to be the case, right? But at least historically, the odds are not good for the economy if that's the sort of messaging the Fed wants to put out there. The issue for the Fed is nothing they've done clearly has caused inflation expectations to sustainably pick up or sustainably rise in any real way. And I think a lot of that has to do with oil. Historically, oil tends to be the best correlated commodity to inflation expectations. As market participants look at oil day to day, they view that as a source of cost push inflation. That should cause inflation expectations to rise, which should then prevent the Fed having to lower rates to try to spark inflation. And that is consistent with emerging markets rallying, with commodities in general rallying. I think for the Fed to ultimately get this right and the ECB to get it right, they need commodities to help them push through an expectation of rising prices, which should cause an increase in the velocity of money, which also ultimately increases inflation. That has a lot of implications on various sectors of the stock market, the main one really being financials. A lot of people talk about the disconnect between the value and growth style, right? That you've had this incredible outperformance of growth as a style versus value, not really taking into consideration that the reason that value has underperformed so much is because the largest sector of most value indices is financials. Financials have had a very hard time, largely because they can't really make money when the yield curve is doing what it's doing, right? In terms of lending long and borrowing short. If you're going to bet that the Fed, commodities, that reflation is coming from a sector basis, financials make a lot of sense. If you're betting on a global basis, emerging markets, commodities make a lot of sense. But all this is short term. I still maintain that long term, deflation is probably more likely than not in our future.
So isn't the Fed cutting rates almost a deflationary signal?
Yeah, so this is kind of an interesting thing to think through, right? If central banks are getting market participants used to the idea that they're always going to save the system with lower rates, and if market participants always believe the system always needs to be saved, then you never really have the urgency to borrow because rates will always be lower at some point in the next year or 2 years, 3 years. So if everyone believes that, how can you possibly have a pickup in the increase of transactions, pickup in the velocity of money? So perversely, I think if the Fed continues on this path of trying to save the economy, save the markets by always lowering rates rather than just staying put, you may actually have the opposite effect. They may actually be the reason why inflation expectations continue to go lower, because the idea is that they'll just keep on lowering no matter what.
And so historically, when you look back, when the Fed initially cuts rates, the stock market initially rises, but that kind of marks the top of the market, and then we get the recession and the bear market. Do you think that will play out the same this time?
I still think that with hindsight, I think we had a global bear market start end of January 2018. I think we actually have been in a bear market. And that's the thing about bear markets. You don't know you're in one until long after it's probably over. And remember, you can have bear markets without recessions. Right? This is something that people also, I think, forget in the conversation. A lot of global equities peaked, in late January of 2018. Small caps have not made new highs in the U.S. We've talked about that quite a bit as well. A lot of commodities have not really come back, right? So it could very well be that this has already been kind of in play for some time. We haven't seen a capitulation move, and you haven't seen it in the S&P, which still is the only place to be, as it has been for several years now. The thing is, if you're going to say there's going to be a bear market here, you're inherently then saying something really, really is off, because if you're going to have a global bear market starting right now and then the S&P starts correcting, emerging markets still have gotten crushed already, right? The commodities have already been crushed. A lot of things are already low prices. So yeah, they can go lower, but at some point you've got to probably bet that maybe there already is an overreaction in that disinflation trade near term.
So before you mentioned financials, commodities, how exactly would you go about playing the current environment?
So I think from a sector basis, energy, financials probably make the most sense. I know people still love tech, and tech still has momentum. At some point, that will change. The thing with momentum, there are a lot of interesting studies on the momentum factor. Momentum works, but when it turns, it's like a multi-standard deviation event on the downside, right? So I think that makes a lot more sense now. The defensive sectors, I think, are likely to sell off further. Utilities, which had been abnormally strong, look like they're probably on the verge of really weakening quite a bit. They're also overvalued from a fundamental basis. Healthcare might buck that trend only because they've already taken it on the chin quite a bit. Energy, financials, again, make the most sense. Commodities, we've seen quite a move in gold, and I think that's probably likely to continue. I've had this long-standing argument that the last great bubble is faith in central banks to solve all problems. That the fiat system ultimately leads to tremendous debt over the long term. Democracies ultimately lead to tremendous debt because politicians have to always promise new and better things, and that means taking on more money, borrowing more money. At some point, you get to some saturation in debt levels, and maybe then the market says, well, there's something to gold standard. Maybe there is something to discipline that comes with the yellow metal. And maybe they were starting to see some of that reasoning, play out. Same thing maybe with Bitcoin. It's probably one of the same kind of thesis here. So I think broadly speaking, commodities make a lot of sense. And again, I go back to a lot of what I think is happening here really does relate to the dollar. The dollar has sold off the last couple of weeks. I expect that to continue. I think at the end of the day, that matters more than anything else. The dollar weakens, dollar-denominated assets rally, inflation expectations rise, Fed won't need to cut, and that probably does give more credence to the idea of a reflation trade to come.
So as this reflation trade unfolds and the dollar weakens, you're also looking at emerging markets as well, is that right?
Yeah, and look, I know there's still a lot of talk around China and whether something's going to happen or not. I suspect that Trump's reelection matters more than a trade deal. And what I mean by that is, if a lot of the reason why he might get reelected is because of the economy and the stock market, he's got every incentive to keep pushing that higher. And in some ways, it's kind of the best timing, because if you're going to do it, you want to do it towards the tail end of a pre-election year so that you have something to hang your hat on during the election. So I suspect that that's going to get done fairly quickly. And that may be why China itself is starting to rally too.
So China is a huge part of that EEM ETF. Does that worry you at all?
No, I like it. If this is where all the bearishness has been. Look, there's a lot of politics, a lot of theater when it comes to this stuff. We saw the theater with Mexico, and that was the same week that you had that poor jobs report, as I recall, and it only took 5 days or whatever it was for Trump to say, "Oh, we made a deal." Nobody really knows what the deal was, but all those concerns around Mexico very quickly went away because there was concern about how it would impact the markets. This is a higher stakes game with China, but I think you're going to come to some kind of agreement, and whatever the agreement is, whether it's good or bad for the U.S. or for China, it won't matter. It'll catch a lot of people off sides if it does happen, and potentially cause a rush into Chinese stocks.
So how much upside do you actually see for emerging markets, commodities, and financials?
Yeah, so look, I think I mentioned before in the few weeks ago that emerging markets, when they run 2,000, 3,000 basis points over the S&P pretty quickly. You could have this kind of convergence trade. I think that's still obviously very much in play. I think financials have substantial outperformance potential if the reflation trade plays out. But again, all this is short term. I want to just reemphasize this. I think very long term, there's still some very serious problems. The yields have not really risen just yet, right? So all this is pursuant to the idea that yields actually react the way they should in a reflationary environment. If they don't, that to me is a much bigger problem. And I know, again, I go back to, you don't really know which scenario plays out. Either the bond market's right or it's going to be wrong because the central bank's going to force it to be wrong. If that's the case, substantial outperformance in everything outside of the S&P. The S&P to me is the last general that you don't want to bet on. It's old, it's tired, it's worked phenomenally, but if you're a believer in buy low, sell high, I don't know why you would want to touch large caps here.
So Michael, when you say short term for this reflation trade, what do you mean exactly by that?
So I think you're talking the next 3 to 6 months, right? That you're going to have some kind of reflation trade, or at least let's call it oversold disinflation bounce. I'm saying that because if the yield curve inversion ends up being correct, that the recession is coming, it's hard to see a recession with inflationary pressures given the way things have played out. So you really only talk about maybe 3 to 6 months out. If the yield curve is wrong, it could be much longer than that. If the yield curve is right and you have a recession in the election, during the election year, then a lot of those oversold bounces start resuming downward.
Well, Michael, that was great. We'll see how it plays out in the months to come. Thanks so much for joining us.
Appreciate it.
So Michael is bullish on emerging markets. Specifically, he likes buying the iShares MSCI Emerging Markets ETF, ticker symbol EEM, to S&P 500 ratio at current levels. He sees 20 to 30% upside potential over the next 3 to 6 months. He also likes buying financials and commodities as a way to play the reflation trade. That was Michael Guyot of Pension Partners, and for Real Vision, I'm Jake Merl.